Good morning, everyone. So, as Kay said, today I'm going to be talking about family investment companies, but I thought it's worth just setting the background to these before we dive into the detail. So what we're really talking about here is inheritance tax planning, estate planning. So if you are willing to make gifts to your children, to your beneficiaries, whoever that may be, then a simple gift is always going to be simpler and as straightforward as you can get, and it will reduce your estate for inheritance tax purposes. It remains to be seen in the budget what will happen there. But generally, that's going to be the easiest way to get value out of your estate. Now, there might be reasons you don't want to do that. The most common ones are things like control over the family wealth and asset protection. So things like what happens if you make a substantial gift down a generation and then that person perhaps get divorced or is made bankrupt. What if they go and put it all on red in the casino? You want to be able to protect that wealth that you've spent time building up and effort putting together in your lifetime. So what we're really talking about when it comes to family investment companies is a way to make a gift, but with bells and whistles on. So with some protections over that gift. So it achieves the same thing as making a straightforward gift of cash in terms of getting value outside of your estate. But the idea being that you are protecting that wealth. So what we're talking about here today is family investment companies. So a family investment company is really just a company that is set up to make investments on behalf of the family, like it says on the tin. It's not a special type of company. It can just be a limited, normal company, can in fact be an unlimited company, and we'll come on to that in a bit more detail as we go through. So you can set up a family company to administer the wealth. It can also be teamed with trusts. So we will touch on trusts today, but it's not going to be the main focus of today's webinar. But trusts can also be used to be a shareholder. I would suggest the difference, whether you use a trust or not, is the legacy you're looking to leave. So a family investment company works well to benefit the generations who are alive today. A trust can benefit generations who aren't in existence today. So if you only have children, trusts can be set up for the benefit of grandchildren who are not yet with us, for example, or indeed grandchildren or future issue, or nephews and nieces or cousins, whatever you would want to benefit. So trusts just give you that wider ability to benefit people who, a wider scope of people, essentially. Essentially, if you set up a family investment company, you're being very specific as to who's going to benefit from that company. So that's really the mindset you need to have between using trusts and companies, I would suggest. So in terms of setting up the family investment company, the parents would typically be the directors. We sort of look at these as family investment companies because we're looking at sort of a nuclear family with parents and children, grandchildren, wider family beneficiaries. So in our references to parents, we would look at those with considering those people to be the setup, but it could easily just as well be grandparents, for example. So we'd say the parents could be the directors of the company because ultimately directors are the ones who control companies. It's not shareholders who control companies, it's directors who are appointed to run the companies. The directors therefore have the power over to what to invest in and importantly, when dividends are paid out, distributions are made. So it's when assets are then distributed out to the company. So it's that directorship that gives the parents the control over the investments, teamed with how the company is set up with the Articles of Association to limit powers of shareholders and what certain share classes can do. So typically what we would do is set up a company, incorporate it. The parents would typically lend money into the company. That's how you get the wealth into the company. The company would then go ahead and then start making investments with that cash. In terms of who the shareholders could be, parents don't have to be shareholders at all. I mean, they could be. It depends how you set up the article so that they may have power through perhaps an A class of share that gives them all the voting rights. You could have beneficiaries being, say, a B class of share that just have rights to capital value in the company. So that's assets on a winding up, potentially, typically sale proceeds, but family investment companies are not really sold. They're normally liquidated for capital distributions. And then so they wouldn't necessarily have voting rights or dividend rights. Dividend rights is up in the air. You can decide if you want to put those on upfront or add those on later. So you can split up the shareholdings so that different beneficiaries have different rights over the shares. The articles would typically give power for the parents to buy back the shares or cancel the shares in some form, so that if there was some form of divorce, there would be a power in the articles which would enable the company to control whether those shares were passed over to a next spouse. So you can build in protections into the articles of association so that the asset is protected, the shares are protected. Now, on day one, because you're effectively lending the company money, yes, the company will then have cash in it and an equivalent loan. So let's take an example, just a round number of, say, £1 million. You could lend the company in £1 million. It would have a debt back to the parents of £1 million. It would have cash on the balance sheet of £1 million. Overall, the net value would be basically zero on day one. So that's what enables you to give shares away to the next generations, to beneficiaries, including trusts. There's no real value in that gift because on day one, there's very little value in the shares of the company. So the idea behind the family investment companies is that you're trying to accumulate wealth over a period of time. They're not, if you need the money from the cash you have, if you need the income from the investments to live off, then you have to wonder whether you're going to achieve much with a family investment company. So the family investment company works well because corporation tax rates are typically lower than personal tax rates. The capital gains tax rate is marginal, it's 24% personally, 25% typically in family investment companies. But family investment companies are able to deduct expenses that individuals cannot. For example, accountancy fees. You can deduct those against capital gains in companies as management expenses, which you can't do in your personal name. So overall, you're still typically better off in a family investment company, even if you aim for capital growth. There is also mutterings in the press around whether capital gains tax rates will increase in the budget as well, of course, but we don't have a crystal ball, so we can't say that for certain. So you can set up the company, it starts to make investments. Now, we wouldn't normally suggest that you put assets in a family investment company that qualify for business property relief, because if you have assets in your personal name that qualify for business property relief, then they are going to qualify for 100% relief in the first million and 50% thereafter. Whereas if you just have a non-controlling shareholding in a family investment company, you're going to get zero BPR on those assets. So typically, we would try and avoid having trading company shares inside a family investment vehicle. So family investment companies typically work best with things like listed shares and can be rental properties as well, that sort of thing. So things that wouldn't typically qualify for inheritance tax reliefs. So the other benefit of using companies for things like listed shares is that typically family investment companies won't pay corporation tax on dividends received. So it enables a tax-free roll-up of dividend income inside a family investment company vehicle. So yeah, so as we said, so some of the benefits of the family investment companies is that you do have the dividend tax-free roll-up. The idea is the growth in that value therefore accumulates to the beneficiaries who have capital rights to the company. The parents do still have the loan into the company. So that loan is still an asset in your estate. But there's 2 points there. One is that it's frozen in value. And two, it means you have access to that capital should you have a rainy day and still need it. So you aren't giving away your original capital, you're giving away the right to the future growth in that capital. So it's freezing it in value and it gives you the access to it. If you decide at some point in the future you don't need that anymore, you can give that away as well. Again, either to perhaps a trust or outright to the beneficiaries if it's as a potentially exempt transfer. Yes, I think it's got all that. So as a typical sort of setup then, what we'd look at is a setup by, we'll call them, as I said, call them parents, could be grandparents equally or some other settlor to set the thing up. They normally set the investment company up with loans. they would have the shares that have the voting rights. And you could potentially have rights to income, but typically we're looking at situations where, in effect, this is spare cash that is being invested, and therefore they don't typically need the access to the income, but it's on a case-by-case basis how we set those up. And then you would have the main shareholders being the beneficiaries, so that's potentially children, grandchildren, other beneficiaries you may wish to benefit from. We'd try and avoid them having voting rights initially. That's the whole point of having control over the assets, but they may have rights to income again. That's up in the air. But the main point is that they have access to the capital, and that the capital growth in the business belongs to them and is therefore outside of your estate. But as I say, it's a long-term play. If you're going to need access to the income, then you may well be worse off than if you had made these investments in your personal names, because you're looking at potentially 2 layers of tax if you need access to the money yourself. But something to think about, though, is that at some point parents will pass. So what happens to their shares then? They did originally have the voting rights, they had the control, but now that will have to pass through their will to whoever their beneficiaries are, typically children or grandchildren. So they would then have the voting rights in their names. So then at that point, you would lose control over the structure. So that's why we talked about before that family investment companies work well for passing it down a generation. It can delay the point until which they receive the actual voting rights. So, typically by the time, if you look at the average age of passing in this country, typically you're going to look at somewhere around the 80-year-old mark. At that point, your children may well be in their 50s and you're not bothered about giving them the actual voting rights, etc. However, that's where trusts might come into play. If you want to retain control and you want someone to be able to monitor the situation ongoing, because then what happens to the next generation, the trust could be a shareholder rather than the beneficiaries. And if you set that up on day one, as we said before, the shares in the family investment company are unlikely to have much value in them. They may have some value because if they've got rights to income, for example, there's potential income stream in the future, there's hope value there. They're not going to be completely worthless, but they will be of minimal value when you set the trust up. That trust will then be ongoing. It doesn't rely on whether you are still alive or not. That trust continues in perpetuity, typically up to 125 years. So it's a way of keeping control over those assets and that income, and the ability to pass on to next generations. Now, in terms of the investment company itself, you can have it set up as a limited company. That's just a normal company you would see most families have. It's just a company limited by the amount of share capital you put in, and therefore if anything went particularly wrong in the company, you would be protected up to the amount of the capital you've put into that entity. Now, in certain circumstances, people have also looked at unlimited companies. The benefit of an unlimited company is that as things stand, you are not required to disclose your income and assets on Companies House. So it gives you a degree of privacy, not from HMRC, but just from the general public. So the next door neighbours can't look you up on Companies House and see what your investment company is worth. So if you're in a situation where you're perhaps just making listed investments, for example, and there's not particularly any risk of you losing more than your original capital you put in anyway, then an unlimited company may be of interest to you. We don't particularly recommend it where you've got things like properties in there, because you've always got this potential sort of hangover for you that whilst, yes, you can get insurance, is that as reliable as having the full limited liability of a company? So if anything went wrong with the property and you were sued, essentially, then, or if you were unable to repay your debts, if you had a mortgage on the properties, then in a limited company, they're limited to the amount of capital you put in. In an unlimited company, they could come after you personally as the shareholders to get repaid for their money. So unlimited companies can work well in certain circumstances. Okay. Now, typically, when we think about these structures, we're thinking about someone who has cash available to actually start these companies, so they're actually able to invest in by making loans, or perhaps looking at you can also do it by preference shares as well. It doesn't have to sort of redeemable preference shares rather than just a straightforward loan, but typically they're made as loans. But what about if you've already got, for example, investments in your personal names already, and you're thinking about, can I put those into an investment company, a family investment company? Now, the things you need to think about those, the assets you own at the moment, do they stand out a capital gain, for example, is one of the biggest things to think about. So if you've got a portfolio of listed investments, yes, in theory, you could transfer those to a company, but you would be treated as having disposed of them at full market value. And if you're standing at a capital gain, you're going to crystallize those gains on which you're going to pay 24% tax probably. So you have to think about whether that's going to be worthwhile. Is there any gains tax in there? And then if you're looking at properties, you also have to think about stamp duty, land tax as well, or perhaps land transaction tax or land buildings transaction tax if you're in Scotland. So at that point, we can look at incorporation of a property portfolio and whether it's possible to actually claim what's called incorporation relief. So incorporation relief is where you transfer an entire business to a company. So that's not going to work if you're just investing in listed stocks and shares. You have to be operating a business to qualify for incorporation relief. And when it comes to a property portfolio, if you've only got one or two properties, you're honestly not going to be able to claim incorporation relief. That's not going to be enough of a business to qualify for this relief. We've only really had one case before the courts which determined what a business is. And this was a case where a lady in Northern Ireland looked after essentially a converted block of a house that was converted into flats, essentially. And she spent around 20 hours a week working on this property. So she was involved in the gardening and the contract renewals and looking after repairs and maintenance of the property. She was visiting there all the time to make sure it was okay. So by doing that amount of work, it was found that she was actually operating a business as opposed to just making passive investments. And she did the work herself as opposed to outsource it to an agent as well, although there's debate about whether that makes a difference or not. So if you are working 20 hours a week or more on your property portfolio, or at least your agents are, then this is likely to be considered a business, and it's what HMRC refer to in their manuals and their guidance, that they will accept if you're working 20 hours a week, they will accept it as a business. Now, that's not to say if you're spending less than 20 hours a week, you're not operating a business, but it means you may have more of a fight on your hands to try and persuade HMRC that you are operating a business if you're spending less than that a week on your property portfolio. So on that basis, it's likely to mean that you can only claim what's called incorporation relief if you've got, say, 8 to 10 properties. It can be possible with fewer. You'd have to look at your own personal circumstances to see whether that's going to be possible to look at. So we would need to look at your individual circumstances. So we need to look at whether it's right for you. So yes, companies pay lower rates of corporation tax on rental income than you would do in your personal names. So if you were looking at rental income, yes, you pay up to 45% in your personal name. You're going to pay a maximum of 25% in a company, depending on your profit levels. But again, as we mentioned before, if you need money to live off from this rental portfolio, then we need to think about whether the extra tax you're going to pay, so that's the corporation tax and then the personal dividend taxes on extracting that money, or potentially salaries, would actually end up meaning you pay more tax than if you just left the property in your personal names. So it's again dependent on whether you really need that money. What we're really looking at here is situations where perhaps you don't need the money to live off on those particular properties. You may have independent wealth elsewhere from employment, from pensions, from other investments you may have, but you could move that portfolio into that, leave it, and then let the growth as opposed to the current value move into the children's names. The current value would again stay in your name. Now, with properties, there's added complications. So you're more likely to have mortgages and loans involved with properties than you are with listed investments. and it needs to be done correctly in order for incorporation relief to be claimed. So for incorporation relief to be claimable, an entire business needs to move from your name into a company. So you can't really pick and choose which properties move. It would have to be, if they're all in your personal name, all of the properties. If you're looking at joint only owned properties, all of the properties in the same names would have to be included in that company to qualify. And when we say business, that includes the loans. So the loans would have to move across as well. So the banks would need to be on side, the lenders would need to be on side to be able to achieve that, because they would be willing to assist in helping you move the loans across, which with a company that's got no trading history may be tricky, maybe easier said than done. But with potentially personal guarantees from directors, there are lenders who are willing to participate in this exercise and achieve the goal. Now, the big cost to doing all this is stamp duty, land tax. So if you move all of your personally owned properties into a company, you're going to end up paying stamp duty, land tax, or taxes in Wales and Scotland, similar taxes, on the market value of those properties. And because it's a company, it's automatically liable to the 5% surcharge for second properties. So you're paying a minimum of 5% on the properties that are moving across into the company. Now, there are potential ways to mitigate the SDLT if you are operating as a partnership. So there are specific partnership rules which allow transfer from a partnership into a company without necessarily incurring the stamp duty, land tax, provided the owners of the company are effectively the same people as the owners of the partnership. HMRC would need to be convinced that a partnership exists. So if you've just got jointly owned property, say between spouses, then that can be tricky to persuade HMRC that's anything more than just joint ownership, that it is actually a partnership. But there may be things we can argue in that respect. But on the face of it, there will be a stamp duty, land tax charge on transferring properties from personal names to a company. That would be the default position. So, having sort of jumped through all those hurdles, that potentially looking at capital gains tax on transfers and SDLT, if that's still then a goer, then we can look to move properties into a company. And similarly to the family investment company idea, we could have a class of share going to the beneficiaries, which again has rights to, say, future growth rather than current growth. They could also have rights to dividends if they so need it. And again, trust can be involved as a shareholder. So you can set the thing up in a similar way to a family investment company, such that the original capital remains in your names, but the future growth moves outside. So overall, yeah. So whilst I typically wouldn't necessarily consider a property portfolio moving into a company in the same way as a family investment company, it's a question we often get asked when we talk about family investment companies: can I move my existing properties in? So we thought best to cover this off today as well, as it's a common question we have. Okay, and that's broadly the content for today. Have we had any
Thank you very much, Tim. I'll leave the copyright and disclaimers on the screen for a moment. We did have an email come in just earlier, and it said, I know you don't have a crystal ball, Tim, but it says, what are the risks if tax laws change? And could these changes make family investment companies less favourable?
Yeah, fair enough. Good question. So what I would say is the real risks are if things like the dividend exemption for corporation tax gets removed, so you end up paying corporation tax on dividends. If corporation tax rates were to increase, that would be a downside. I think it's difficult to see how they would really be attacked. HMRC have already reviewed family investment companies in some detail. They spent about 3 years reviewing these structures and concluded that they are not being used for tax avoidance, because if you actually think about, if you actually need the wealth out of the company, at that point you will be paying tax on the extraction of this value. So because of that, they concluded that yes, it's a tax deferral mechanism in a way. So in reality, you're really just growing the value, but when you actually come to take the value out, if you need the cash that's in that company, you will be paying quite substantial amounts of tax. But the idea is you still end up net better off, because during the lifetime you've paid a lot lower tax in the company than you have in your personal names. Now, yes, there's risks about personal taxes. So on extraction, if there's extra dividend taxes, if there's extra capital gains taxes, if you come to sort of liquidate the company and pay capital gains tax, you may pay more than today's rates. But the idea is that you'd still be better off than if you'd own that in personal names, because you'd still pay those capital gains tax rates in your personal names anyway. And that the idea is it's going to grow over the lifetime of the company. So the real risk is if the corporation tax rate then increases substantially, because then you're not going to have as much growth in the business as you were originally. It seems unlikely that that's on the cards at the moment. It's 25% is the highest it's been for quite some time. It was 19% for a number of years. So I would suggest it's unlikely these structures are necessarily going to be attacked because they're already subject to tax. So it's not like there's any loopholes we're diving through here. The idea is that you're just benefiting from the corporation tax rate and the corporation tax exemption from dividends.
We have another question. What level of wealth makes a family investment company worthwhile?
Yeah, that's a good question, because I was thinking about that on the train on the way in, to be honest, what the answer to that was, because I thought that might come up. I would suggest you typically are going to need enough income from your investment company to pay the admin costs of running a company to make it worthwhile operating. So you're going to need, I would suggest, a few $100,000 of cash to make this worthwhile. So once to actually accumulate enough income that you would have paid, the higher rates of tax in your personal names. If you're a basic rate taxpayer and you're only generating 20,000 of income, for example, you're not going to be really better off by having a family investment company. You really need to be paying personal taxes in the higher rates. You need to have sufficient cash that you're actually going to generate enough money to pay the admin costs of running a company. So I would have thought you'd need a few $100,000 to make this worthwhile. So I would say probably $300,000 to $500,000 would be a sort of minimum, really.
Tim, you've been the question.
Great.
So you can relax. Thank you all again for joining us this morning. If anybody else would like a copy of the slides, please do send me an email and I'll ping them over to you later today. Thank you very much for joining us, and I wish you a pleasant day. Thank you. Bye-bye.